Just last week, the Federal Reserve Bank of New York reported a record high in its foreign repo pool. This is a Eurodollar liquidity buffer that foreign institutions use. And when it's rising, nothing good is happening. Eurodollar participants are increasingly nervous about the availability and circulation of money in the global system. FRBNY also reported that U.S. primary dealers are holding an enormous and growing inventory of Treasury notes and bonds, one that's very close to its own all-time high. The last time primary dealers reported financing this many Treasury coupons, it was in the middle of March 2020. Both of those are consistent with the bull steepening going on in the Treasury market, but it's not just Treasuries. There's been an even more aggressive move in the European bond markets, a bull move in European bond markets, in particular Germany. Sure enough, the ECB reported last week that European banks are in the middle of that one too. You get the sense from all of this that the global monetary and financial system isn't looking at recent consumer price estimates as just benign disinflation. It's also not thinking that the wave of central bank rate cuts that's already underway is just a few over-careful officials making sure an otherwise healthy global economy stays that way. Unemployment has been rising all over the world, including the United States. And markets are increasingly pricing that as recession. And that's the bull steepening. But monetary conditions are also tightening up, both out in the open as well as in the shadows. And today we'll start out with a tightening in the open, in the foreign repo pool, the Federal Reserve's original reverse repo program. The foreign repo pool is something that foreign governments and reserve managers use when they quote-unquote lend cash to the Fed. Essentially, this is a correspondent account where foreign reserve managers hold liquid balances in US dollar terms with the Federal Reserve Bank of New York as its custody. As an accommodation to these foreign reserve managers, the Federal Reserve offers an investment opportunity or an investment return for this liquid cash balance. That's the repo part of it. So essentially, the Federal Reserve pays a repo rate to these foreign institutions as they hold cash in this repo program. And it's collateralized by U.S. Treasuries, not that it really needs to, but it's essentially like a repo opportunity for foreign cash managers. As of the latest week, which was July 24th, the amount in the foreign repo pool was $468.8 billion. That's a record high, and it's the first time it's been above $400 billion. Now, it had a previous record high in the middle of June, which seemed to be consistent with the marketplace getting a little more nervous about what was going on in Europe. But as the European mess kind of cleared itself up, now we're seeing another resurgence in the foreign repo pool and a number of other indications, as we'll get into a little bit here. But essentially, it wasn't necessarily about Europe, yet here are foreign managers piling up more cash with the Federal Reserve Bank of New York. As I said before, the reason that foreign reserve managers hold a cash balance with the Federal Reserve Bank of New York, they get a decent return, and that's the repo part of it, but mostly because they're increasingly nervous about conditions throughout the Eurodollar system. So they hold a higher liquidity buffer, as former open market desk manager Simon Potter said in 2016. That's why this foreign repo pool usage corresponds so closely with our Eurodollar cycle. So as we see more cash pile up in the foreign repo pool with the Federal Reserve Bank in New York, that's more of a signal that things are tightening up, and reserve managers are holding a higher liquidity buffer as a defensive mechanism against it, defensive measure against possible downside tightening consequences. The tightening in the Eurodollar system that goes along with all that, we can see that as well. We've talked about the dollar exchange value that's stronger than it really should be, given the fact that the Fed's going to cut rates any day now. All signs point to the Fed cutting rates, maybe not this week at its meeting, but very likely in September. And it was Bill Dudley just last week who did urge the Fed to cut rates as soon as this week. So the market and everybody in between knows the Fed's going to be cutting rates. Yet the US dollar exchange value continues to hang in there against most currencies, if not be stronger against a whole lot of others. The US dollar exchange value that's strong and moving higher is a sign of tightening in the Eurodollar system. It's the other side of the foreign repo pool. There's a close correlation there. Repo pool use goes up, this dollar exchange value goes up because the one is reflecting conditions that are reflected in the other. And we've been focusing on China's yuan and Japan's yen, but it's not just those two. Start out with India's rupee. India's rupee just hit another record low, 83.76, 83.80. Even though the Federal Reserve is supposed to be cutting rates, the rupee continues to move lower. Well, it would move lower if the Reserve Bank of India would stop intervening, but the Reserve Bank of India, like the government officials in Tokyo, as well as the PBOC in China, they're trying to slow the decline in the rupee so that it doesn't become disorderly. But it still wants to go down because Eurodollar conditions are tightening. But you're not allowed to say that because of the Federal Reserve and its bank reserves. So I'll give you an example. Reuters this morning reported on the India rupee's record low, and they were struggling to come up with a reason why that was the case. They said factors such as outflow from local equities, volatility in the Chinese yuan, that's putting it kindly, and tepid risk appetite have contributed to weakness in the rupee in recent sessions. The currency has hit all-time lows in 5 out of the last 6 trading sessions, even though the Federal Reserve is going to be cutting rates, and everybody knows the Fed's going to be cutting rates. Here is the dollar still increasingly strong against the rupee. Tightening. At least they got that one part when Reuters said tepid risk appetite. It's actually a little bit worse than that. We're seeing risk aversion rising all over the place, including the tightening that's indicated in these dollar signals. Another one, Brazil's real. The Brazilian BRL hit 567 this morning, which is matching the low from earlier in July. And those are both the lowest since the start of 2022. That's despite the fact that the Federal Reserve is going to be cutting rates. At the same time, the central bank in Brazil, Banco do Brazil, is holding rates steady at 10.5%. They were cutting rates and they cut them through May, but now they're holding rates steady at 10.5% because they're worried about really the decline in the currency, which is reigniting consumer price pressures all throughout Brazil. China's yuan, the one that we've been focused on a lot, right back to 726 to the dollar after being as high as 722 last week as JPY made an aggressive move in the aftermath of carry trade stuff and interventions. But right back to 726, so weakness in China's yuan. Reuters called it volatility. That's putting it kindly, as I said. And Japan's yen, after seemingly hit its recent high at around 153.60, 153.70. It's moving back toward 154. That's after the intervention, the CPI, and again, like everything else, the Fed is supposed to be cutting rates, the Bank of Japan is increasing rates. Yet all of these currencies are weakening at the same time foreign reserve managers are holding higher cash balances in New York City with the Fed. Tightening throughout the Eurodollar system becoming substantial enough that foreign reserve managers are holding a record high balance in the foreign repo pool, a record high liquidity buffer. With all that's going on around the world in terms of rising unemployment, economic uncertainty, as well as this tightening in the Eurodollar system, we saw not just an aggressive bull steepening in the US Treasuries, but an even more aggressive bull steepening in the German bond curve. As of this morning, there's a little bit less bull steepening because the long end rates have moved down a little bit more today and Friday than they had previously, but still, it's a pretty substantial and sharp bull steepening move in Germany. Since May 31st, when this rally got started over in Europe, the 2-year German bond yield is 50 basis points lower. That's two additional 25 basis point rate cuts from the ECB. That's already with the 2-year well below where the ECB topped out anyway. So the twos are way below where the ECB got to, and now they're 50 basis points lower over the last, call it 2 months. The 5-year BOBO, that's down 46 basis points over the same period going back to May 31st, while the 10-year is only down 35 basis points. So the 2-year has steepened 15 basis points. Really, it's flattened, meaning it's less inverted to the 10-year by about 15 basis points since the end of May. Whereas the 30-year, is down 26 basis points. So the twos have caught up 24 basis points on the 30. It very nearly uninverted last week, the 2-year and the 30. Came within a couple basis points before backing off again today. So the 2-year, 10-year as of Friday was about 19 basis points inverted, which was the flattest that part of the curve had been in a long time. It's back up to 22 basis points today. The bull steepening in Germany's market is the same thing as the bull steepening here because it's a globally synchronized system. We've got rising unemployment in Europe, or the European economy that's rolling over. At the same time, the United States is showing all the same kinds of recession signals. And in between, a Eurodollar system that is tightening up substantially. And one group of market participants that is big time onto safety and liquidity, that's the European banking system. The ECB reported last week on the credit statistics, the balance sheet statistics from 4 European banks, or monetary financial institutions, or MFIs as they call them. And according to the ECB's reports from all the banks, government bond holdings among European banks in June increased by 25.5 billion euros just in the month of June. Going back to January, the end of January, European bank government bond holdings have increased by 123.8 billion. And it goes without saying, but I'll say it anyway. European banks hold more and more government bonds during periods when the European economy is either in recession or heading toward one, or was describing conditions that are consistent with tightening or even a banking crisis in some of the earlier episodes. Safety and liquidity. When safety and liquidity are in demand, that's nothing good about safety or liquidity. And when safety and liquidity is in demand among the banking system, there's going to be monetary and financial consequences as well as real economy problems too. Another one that we keep watching from European banks is their loan activities, or the amount that they're lending to non-monetary financial institutions, financials. These are essentially investment funds. And just like when European banks are holding government bonds, when they're holding more government bonds, when European banks are lending more to these non-bank investment funds, nothing good is going on. Usually because there's some kind of relationship there, either as a sponsor, as an equity holder, or as one of their best customers is a sponsor or equity holder, whatever the case may be. Essentially, when these non-banks run into trouble in wholesale marketplaces, they come running to the European banking system for some kind of funding, some kind of backstop funding. And European banks give it to them during these periods when things are going wrong in the monetary banking and economic system. In June, according to the ECB, lending to non-MFI financials increased by 32.5 billion euros. And since December, it's up 103.8 billion euros, which is an enormous sum. The last time we saw something like this was in 2022, when Europe is in danger of falling into crisis, and before that, in the middle of 2020. In the United States, back here in the US, the Federal Reserve Bank of New York also reported, as I mentioned in the introduction, that U.S. primary dealers are holding, or really hoarding, U.S. Treasury coupons to a degree we haven't seen since the middle of March of 2020. According to the latest statistics, as of the week of July 17th, total coupons being financed and held by U.S. primary dealers was $217.1 billion. And just like the foreign repo pool, there had been a spike in dealer inventories in the middle of June, which seemed to be a collateral fallout, tied to the collateral fallout with European bond spreads, with the election and everything else, the volatility in June. But as the election faded and things started to normalize, though French bond spreads are still elevated today, U.S. dealer coupon holdings surged again in the middle of July to, like I said, the highest since March of 2020. Now, I should note that there isn't any repo fails really being reported here in the U.S. dollar, U.S. Treasury, using U.S. Treasury collateral outside of the quarter end. That's become a recurring theme in 2024. There's a spike in fails with each quarter end, but outside of the quarter end, fails continue to be pretty benign, which suggests that U.S. primary dealers are stocking up on these coupons, these U.S. Treasury notes and bonds, as a precautionary measure, thinking that collateral difficulties are going to be an issue maybe just ahead of us down the road at some point. There's only a couple reasons why primary dealers would hold so many notes and bonds in their inventories. And what you'll hear most often is there's too many treasuries. Dealers are getting stuck held treasury securities because the federal government is issuing too many. They can't sell them into the market, and so they have to put them in their inventory and finance it in repo markets. It causes enormous difficulties in interest rate swaps and other things. And this is just complete nonsense. And the last couple of months show once again why it's nonsense. Because if dealers were getting stuck with U.S. Treasuries because there's not enough bidders at auctions, which we know is not true, But even if that was the case, and they were holding U.S. Treasuries because they're obligated as primary dealers to buy up what's left over at auctions, there's no law that says they have to hold them in inventory. They can sell them. And since we're experiencing a bond rally, and a substantial one, a bull steepening bond rally in the U.S. Treasury market, there are plenty of people in the marketplace who would be willing to take those coupons, those notes and bonds off of primary dealers' hands. This is not about too many treasuries. This is dealers choosing to hold more coupons in inventory. And there's really only two reasons why they would do that. Two real reasons, not that too many treasuries nonsense. The two reasons are, number one, a defensive measure. Because they're concerned about potential collateral breakdowns in the future, they want to hold more treasuries in their local inventory, in the inventories on their balance sheet. In case collateral does break down, they already have the treasuries in inventory to correct any problems as they might show up. And the other reason they would hold lots of treasuries is because if they realize, or if they do expect the same thing, that the collateral system is about to experience disruption, then they're holding treasuries in inventory intending to profit on the fact that other people, other parts of the system, other participants in the system are going to be willing to pay a premium to borrow those treasuries that dealers now have in inventory. So it's both sides of really the same thing, collateral difficulties. On the one hand, being defensive, protecting themselves against potential collateral breakdowns and really expecting collateral breakdowns up ahead. And some of the others are looking to profit from the same thing, knowing that participants in the financial system, collateral deprived participants, are going to be willing to pay a higher and higher premium as collateral flow breaks down. Got a record high in the Federal Reserve Bank of New York's repo pool, foreign repo pool, which is really reverse repo. Essentially, it's a liquidity buffer that foreign institutions have available, and they use it quite extensively when they're increasingly concerned about liquidity conditions tightening up throughout the Eurodollar system. In terms of collateral, U.S. primary dealers are stocking up in a huge way on U.S. Treasuries, especially notes and bonds. And they're doing so not because they see something happening now, but very likely because they're anticipating difficulties in the near future. And European and U.S. banks are big buyers of those government bonds as curves around the world bull steepen. Germany's bull steepening has been even more aggressive than the Treasury market, but it's basically the same thing, same view from different sides of the Atlantic Ocean. And it's bullish only for those who are holding safe and liquid assets. Basically everything that we're talking about here, from the dealer hoarding of treasury coupons to the foreign repo pool. Talk about safety and liquidity, higher liquidity buffer there. The entire monetary and financial system, it's not looking at rising unemployment and falling CPI rates as if the chances of a benign disinflationary soft landing are growing. It's just the opposite. With a CRE bust to contend with and China increasingly falling apart, everything is tightening up. What does happen when the Fed starts cutting interest rates? Nothing good, I can assure you. And you don't have to take my word for it. We went over the evidence in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers, especially all you new members and subscribers. And until next time, take care.